Now that we have an understanding of the accounting equation and the rules of debits and credits, let's take a moment to look at an example and see how each transaction would be impacted. So Moss Studios has the following transactions during the month of March. We will read all these later. There's no point in reading them twice here, but it's asking us to record each transaction, and it tells us the accounts they use. So it sort of gives us a hint as to what accounts we need to use for this problem. Now, we are going to record each of these transactions in the general journal. So here's the recording, but we're going to take it a step further than just recording. We're going to indicate how each of those actions impacts the financial performance, which is the income statement, if it does, and the financial position or the balance sheet of the company. So every time we journalize, record the transaction, we are going to indicate how that actually impacts the financials of the company. So let's start with March 5th. On March 5th, we purchased supplies of $1,500 on account. Now remember, debits and credits is basically sources and destinations. It's items that we're using in order to create assets, expenses, or dividends. So let's go through there. What are we buying? Well, it says we're purchasing supplies. Now each transaction will basically give away the actual accounts that are being used. So purchase supplies. Logically, our supplies is going to be our destination. Well, what are supplies? Well, it's things that bring us future economic benefit. Therefore, they are assets to our company. So is our supplies going up or down? Well, in this case, they're going up. So as supplies increase, do we need a debit or a credit to that account? Well, we've got to debit that. Now, I am going to follow good journal form. I know most systems do not require this, but I like my debits first, followed by my credits. So that's how we're always going to do it for my accounting classes. Debits first, followed by the actual credit. So we're going to debit the supplies, because that is first, for $1,500. Now what's offsetting that? Well, what's the source of that asset? It can be one of two things. We can either spend additional assets on it, which would be cash, because we can purchase things with cash, or we purchase on account, which means we now owe a creditor to our company. Well, what does this say? It says on account. Well, do they owe us money or do we owe them money? Well, we're the buyer here, so we owe the other person money. So would it be accounts payable or accounts receivable? Well, receivables are when people owe us. Payables are when we owe them. So in this case, we're going to have an accounts payable because we owe the money. That is debt. It's going to be a liability to our company, so we need to go in and show that. Now, how's this transaction impacting the income statement? Well, it's really not. Remember, the income statement only shows revenues and expenses. Neither of these accounts are revenues or expenses. Supplies are assets. Accounts payable is a liability. So the actual impact here, if you go over to the balance sheet, is that our assets are going up by $1,500. I'm just going to put $1,500 and hope that it actually fits. It doesn't really, so let me just decrease my font here a little bit, because I want that to fit on one line. There we go. So yes, my font's a little different. Actually, let me just highlight this whole thing and make the font smaller so it'll fit. But I want you to be able to type that in there into the grid so that we can see it. So let's take this down just a little bit. Hopefully that way all of it will fit. All right, so now let's take that one back up though. There we go. Sorry about that sort of moment. But our assets are going up by 15. Now what's happening here? Accounts payable. Is it going up or down? Well, it's a liability account, and in this case, our liabilities are also going up. So we're going to go in there and type 15 as a liability. So again, just one more quick pause to fix this so that everything is sort of consistent. We'll give it a nice 8 and hope that fits. Nope. So we need to go down and do 7. See if a 7 will fit. Perfect. So we're going to make that 7. All right. Your handwriting, so you can make this as long or short as you need, but I need it to fit in there so it looks nice and neat. So notice our assets are going up 15, our liabilities are going up 15 as well. So the accounting equation, assets equals liabilities plus equity, is in balance in this case, which is nice. This equation must always be in balance. All right, so let's look at the next one, March 11th. On March 11th, we provide services, $4,300 to customers, and we receive cash. Okay, So again, look at our keywords here. Provide services. That indicates to me that I've done something to earn money. So what do we call it when we perform an action, sell a good, and actually earn money? We call it revenue. So that would be service revenue for our company. And how did they pay for this revenue? In other words, when we provided the service, did we bill them or did they pay cash? Well, in this case, it says we received cash. So this is a cash customer. So that tells us our two accounts involved is cash and service revenue because we provided services. So let's start with cash. Is our cash going up or down? It's going up. So in that case, we actually need to debit cash for the amount of cash received here, which is going to be $4,300. Now what's going to offset that? Well, we've already determined that service revenue offsets it. So is service revenue going to be a debit or a credit? Well, revenues are credit accounts to increase them. So we're going to go in and we're going to credit the service revenue. Again, that's our source of our cash is through revenue, 43. Now, how does this impact our accounting equation and the income statement? Well, let's start with cash. Is our cash going up or down? Well, it's going up. Now, does that impact the income statement? Well, cash alone does not because it is an asset account. So we're going to go over here and we know that cash is going up, which is an asset 43. Now, service revenue. What type of account is service revenue? Well, it's a revenue. So is our revenues going up or down? Well, revenue goes up. And when revenues go up, income goes up. And when income goes up, our equity also goes up. So when we have that type of event, we understand that as revenues go up, that's going to increase my overall income. When the income is impacted, so is equity, because remember, equity is comprised of owner's equity, which is the owners paid in, what the owners have paid in, minus the dividends, plus the revenues, minus the expenses, and that's the basic form. So the revenues, the expenses, and the dividends we refer to as retained earnings. So as income goes up, our retained earnings, which is a part of equity, also goes up. All right, so let's look at March 21st. We pay utility bill for the current month of $450. Well, again, pull out the keywords here. Utility bill, which to me indicates an expense. We're not prepaying it, so we've already paid it. So it's going to be utilities expense. And that is going to be our debit. So our utilities expense is going in at $450. Now, how did we pay for it? Did they bill us or did we actually pay it? Well, when it says the word pay, the only way we can pay is through cash. So our cash is going down. So we're going to go in and we're going to credit cash for $450. So let's talk about the impact here of our financials. So let's start with utilities expense. What type of account is utilities expense? Well, it is an expense, which is an income statement account. So our expenses are going up or down. Well, our expense is actually going up. It's generating expenses. But here's the key. When expenses go up, what happens to income? Well, expenses reduce the overall financial performance of the company. It reduces our net income. When we reduce net income, what do you think happens to equity? Equity goes down. Okay, I know that can be a little bit confusing, but expenses, as they are increased, as we have more and more expenses, our bottom line income goes down. Therefore, our overall claim against the assets as the owner also goes down. Way to think of it, revenue is never free. It always costs us money to generate revenues. For example, you go to work. Does it cost you money to go to work? Well, some people will instantly say, well, no, it's free for me to go to work. Well, no, you have to be able to get to work. So you have to have transportation. It costs you money, whether you own a vehicle or you use public transport. It typically always costs money to get to work. You have to have clothing. Clothing costs money. You have to have food in order to perform. That all costs money. So revenue is never free. It always costs us something to generate. So that's what an expense does. It reduces our performance, and therefore it reduces our claim against our assets or our revenues. All right, now what about cash? Well, cash is going down here, so we're going to say, well, cash is going down by $450. So we're going to put that in brackets as well to indicate that it reduces. Again, notice the balance sheet these three accounts or sections must be in balance. So as we reduce one side of the equation, we either have to add back to assets or reduce the other side. So we reduced assets, we reduced equity, we're still in balance. All right, let's continue on. Actually, let's split our screen just a little bit lower so we can continue to see those template there. All right, so again, continue on. We're going to look at March 25th. We provide services of $1,800 to customers on account. So again, here there's that keyword, provide services. And what do we say about that? Well, anytime we perform a service or sell a good, we have earned revenue. So we get to recognize revenue here. And since it is a service, we can simply call it service revenue. That's just a general term. You can have multiple types of revenue, but we're going to be general here to say service revenue of $1,800. Now our revenues here, since we provided the service, is going up. So would that be a debit or a credit? Well, revenues would be a credit. So let's come back to that. To customers on account. Now remember, when we generate revenue, we have to understand it comes either in the form of cash, we receive payment, or our customers owe us money. When a customer owes us money, we call that accounts receivable. An account receivable is an asset, so we're going to go in and we're going to debit accounts receivable for the amount in which our customer owes us. In this case, it's $1,800. Now, what do we need to credit? Well, we've already discussed that. We said that we earned revenue because we provided the service, so we get to credit service revenue here for that same amount, the $1,800. Now let's discuss the impact of the financial performance and position of the company. Accounts receivable here are going up because we debited that account. Where does that fall? Well, it's not a revenue, it's not an expense, so therefore we need to move on. Is it part of balance sheet? Well, absolutely. Every transaction we record must at least impact the financial position of the company. Otherwise, we wouldn't record it. So here, we know that our assets are going up in the form of accounts receivable. Service revenue, what's going on there? Well, service revenue is part of the financial performance. It's a revenue account. So as revenues go up, what happens to income? Income goes up as well. As income increases, equity does what? It increases as well, so $1,800. Notice our equation stays in balance. We have now seen that this is a good transaction because it's impacting our financial position. I shouldn't say good transaction. It's a recordable transaction. Transactions are always good if it's helping us generate revenue. Sometimes we have a negative impact on performance, but we can't say good or bad there. It's just simply a transaction that we need to record because it impacts the financial position of our company. All right, next, March 28th. March 28th, we go in and we pay workers' salaries for the current month of $3,800. Well, again, keyword there, pay. Anytime we see pay, the only way we can do that is through cash. So is our cash going up or down? Well, if you pay it out, your cash has to be going down. Therefore, we need to reduce cash. That would be a credit to cash. So let's come back to that. We need to find our debit. What are we paying? Well, we're paying salaries of our employees. Well, what are salaries to a company? Are they revenue? Are they expenses? Are they assets? Well, they're expenses. So logically here, we're going to debit our salaries expense account for the amount of salaries that we're paying. And in this case, it's $3,800. Now, what do we need to offset that with? We already discussed that our cash is also going down. So we need to go in and credit cash for $3,800. So let's talk about financial position impact. Salaries expense. Is it a financial performance? In other words, is it a revenue or expense? Absolutely. So this is our expense. Our expense is going up by 38. But remember, when expenses go up, that brings income down. So an increase to an expense account, a debit to an expense, reduces the income, therefore reducing the equity of the company. Again, revenues aren't free. We have to pay in order to generate revenue. So in this case, we have to pay our workers to assist us in generating revenues. All right, cash. Cash is not going to impact the financial performance, but it does impact the financial position. Our cash is going out, so we're going to decrease our assets by $3,800 there. Okay. There we go. All right, and the last transaction on this sheet is March 30th, or this problem. On March 30th, it says that we pay the current month's rent of $1,200. So we're going to pay for the month of March. It's weird that we paid it at the end, but that's okay. When we pay rent, it can be one of two things, either prepaid or rent expense. It would be prepaid rent if we're paying future periods. It's rent expense if we're paying the current period. So in this case, since we're paying the current period, we're going to debit rent expense for that $1,200. And we're going to credit what? What's your keyword? Pay. And when we pay for something, we must be using cash. So we've got to credit our cash again for that same $1,200. So financial position wise, are we impacting revenues? Absolutely not. Are we impacting expenses? Yes. In this case, our expenses are going up by $1,200. And what did we say? When expenses go up, income goes down. It reduces the financial performance. It reduces our income. Does that impact assets? No. It goes straight over. Remember, as expenses increase, income goes down. As income goes down, so does equity. It reduces the overall equity of the company. Here, our cash is not revenue or expense, so we go straight to our balance sheet. Our cash is also going down by $1,200. So there we are keeping the equation in balance. So if we were to add up these columns, we would see what our income is. Remember, whatever impacts income impacts equity. So then we could add up our equity and we could find out what our total balances were. We're not going to in this case, but we could. All right, so I hope this has helped just a little bit understand some of the basic debits and credits. Let me unsplit this so we can have this entire solution on our screen at once. And sort of gives you an indication of how each of our transactions of our business impacts the financial position. If it does not impact the financial position, the balance sheet of the company, we do not have to record it and report it. Okay, so that's the goal of financial accounting there, is to record and report all the events or transactions that impacted the company for a period, and then we report it through formal financial statements, which we'll talk about a little bit later. Thank you.